markets in 90s represented death of capital. And investing itself is both art and science. But I'll say a bit more of art than really as much of science. Because markets are forever fiercely forward-looking, ferocious machine, discounting machine.
You're saying there's a self-correcting mechanism in the market?
Absolutely. Too much will probably lead to mediocrity, and too little is exposing you to the risks.
So how does a stock enter the universe or enter your portfolio?
Decision is not right because the outcome is right.
Right.
Decision is right when it was logical to make that decision.
Right.
Ultimately, every time, even for a long-term winner, you have to constantly evaluate and constantly remain agile to possibility that you may be wrong or you may be foolishly wrong. Ultimately, good investing is about ability to hold two contrary emotions on the same subject simultaneously in your head.
I believe financial literacy is not even present amongst finance graduates or postgraduate. As I keep saying in each of the episode, AUM Finance podcast is based on first principles of investing. We do not discuss day-to-day markets here. We discuss rules and principles which stand the test of time. And you would be wondering whom I have today. So I have Mr. Bharat Shah. Bharat Bhai, to introduce him formally, is the Executive Director of ASK Group. ASK Investment Managers is not only the longest serving PMS player in the country, it is also the biggest AUM manager in the country as far as PMS portfolio management services are concerned. So Bharat Bhai, welcome back. Bharat Bhai, explain the art of portfolio construction. Okay. So there are these differing school of thoughts. One school of thought says that a concentrated portfolio is good. Let us debunk this myth once and for all. For the Gen Z, the current generation who is viewing this podcast, one school of thought believes you should have a very concentrated portfolio. Another school of thought believes in having a diversified portfolio. There is a very famous quote by the legendary fund manager Peter Lynch, have as many children as you can manage. And yet when you historically look at his portfolio, he had one of the biggest portfolio out there, from where the term long tail portfolio comes in. Which is right style?
Well, first and foremost, I'd say constructing any portfolio and investing itself is both art and science.
Yes.
But I'll say a bit more of art than really as much of science. Both are there. But art part, I think, is somewhat larger
than the
science part. Secondly, rarely things which are obvious are true as far as investing is concerned. Because it's
very rare that things which are obvious are true. So you have to read between the lines.
From investment perspective.
Okay.
Because usually markets are too prescient and too intelligent not to take into account what is generally obvious to many people. Because markets are forever fiercely forward-looking, ferocious machine, discounting machine. And therefore it churns, regurgitates, processes all kinds of information in a very, very efficient kind of a combination.
So Bharat Bhai, here I had a question from the prior discussion. Is the wisdom of the crowds evident in a market? If there's a value in a company, how does it happen that the market happens to discover that?
No,
is the market more intelligent? Is the collective intelligence of the market more than the individual intelligence of a single individual, no matter how intelligent? What ensures that discovery happens in the market?
Crowd is different from the core essence of market as an entity. And even in the crowd behavior, popularly many times you believe that crowd is usually less endowed entity and prone to greater errors, which usually is true.
Yes.
By and large, market zooms down to the truth in a ferociously prescient way. This is not to say markets don't make mistakes. Time to time they make mistakes, and huge ones.
Yes.
But markets have great self-correcting capability and mechanism which even brightest and most adaptable individuals lack.
And how does that happen?
That is innate character of the market, where instinct to preserve, to adapt and to grow pushes, much like humanity, to do the right thing.
Just like nature does it, right?
Like nature does.
So just like nature, this human market, stock market, is made of humans, and now probably AI and machines.
Yes.
You are saying there's a self-correcting mechanism in the market.
Absolutely. And in that aspect, markets represent far bigger thing than any individual can. Markets have innately great capability to self-correct. That doesn't mean it is not prone to excesses.
Yes.
Time to time it does suffer from excesses.
Yes.
But its ability to self-correct, ability to course-correct, and ability to ruthlessly move to the right path, best of the individuals cannot.
So એટલે આપણા ગુજરાતીમાં કહે છે ભાવ ભગવાન છે. Is that where that Bombay Stock Exchange mein that is an old saying, right? You're from that.
That's right.
So bhao bhagwan se, if market knows something that you and I are not able to decipher.
Quite often that is true, though not always.
No, not always.
On the crowd behavior, usually we say, like that book by La Gustave, The Crowd, that small little slim book written decades back, where generally crowds are prone to very foolish behavior, intemperate behavior, as we have seen in South Sea Bubble.
That's where the word mob psychology comes from.
The mob psychology, tulipomania and others that we have witnessed. Largely that is true. But there are times when crowd actually displays better wisdom, and then markets have witnessed at that point of time. By crowd, I don't mean necessarily largest part of the market, but enough part of the market. Just in the wake of the COVID, while all the impulses from the various segments was that of fear and confusion and anarchy. All understandable.
All humans were scared. We were all scared.
But enough part of the market reflect counterpoint without worry, and kept fighting.
Was that because a few dominant players who were more well informed could influence?
No, I don't think so.
It is a collective wisdom.
I don't think even institutions necessarily
they were equally scared.
Or
more scared.
A lot of people individually reflected much better in opinion. And that was a fairly significant percentage of the market, in my opinion, to be regarded as some solo or scattered few opinions. No. Therefore, the point that you were earlier asking about whether the construction of investment. So I was saying it is both science and art, but bit more of an art. Secondly, while in general investing is about independent view, where others may or may not agree, and still you can be right, and more often than not that is true. There are also times when large majority or significant part of the market holds an opinion, and it is indeed true. And therefore, being contrarian is not necessarily to be opposed to what is a majority view. Usually that may be true, but there are many times being contrarian is to be intelligently contrarian, not necessarily just because
for the sake of being contrarian.
Mechanically contrarian to the wider held opinion in the marketplace.
So Bharat bhai, diversified versus concentrate versus long tail, which would be the right approach? Or there is...
Now, that is where I say it is both art and science. There is no formula that how much is enough and how much is too little or how much is too much.
Okay.
We all understand that too much will probably lead to mediocrity, and too little is exposing you to the risks that you may or may not have bargained for. But what exactly is too much and too little is something left to the individual ability to deal with the consequences of actions. And a part of that is emanating from the market behavior as to what it has rewarded and human compass to grasp many things. Therefore, when you do too much, chances are that you will not have a good enough and high quality view about so many.
Yeah.
And to that extent, the quality of your opinion will get diluted, and therefore it will lead to mediocrity. But again, that is also a function of human ability to grasp the compass of that individual. The other part of the risk, when you have too little, then you are essentially acting as God. You are trying to say that I know virtually everything that is there to know about that business, that I don't think I have any risk to worry about.
If you have a too concentrated portfolio, that would be what you will say, 10 and less than 10 stocks, 15?
Yeah, 10.
People who claim I have only
yes.
5-10 stocks.
Yes, 5-10 stocks is, in a way, you are acting like God.
Right.
And you believe that you have virtually everything that is there in your circumference.
And in the real world, there are too many moving parts.
And in the
one
real
single
world,
change
there are too
can...
many moving parts. Too many changes. Many beyond your grasp and comprehension.
Yes.
But many beyond your control.
Yes.
And therefore both can happen. The ones that you can't grasp, even though you believe, or you might have deluded yourselves in believing that you know, and then there are things that happen which are outside your control, like COVID, for example, and who knew that such a thing would happen. Therefore, we have to retain humility, that there is only so much we know. That however much we know, we know only so much.
A small percentage of what is to be known.
Beyond that, we know really not much.
Yeah.
And it stems from both the things. Our capacity to know or capability to know, as well as factors beyond our control.
Yeah.
Because however bright you are, there is only so much you can grasp. And therefore, only so much you know is not merely a function of merely things beyond your control. It's also emanating from your capability to know as well.
True.
And therefore, we have to retain humility to understand that there is a boundary to our knowledge, and up to a point that there is something called knowledge and conviction. Beyond that line is actually illusion and ignorance or arrogance. Knowing that boundary will determine what you feel comfortable with and how you do it. Then there is a psychological part, and is not necessarily intellect and capability part. Psychology part emanates from the fact that how you can control the risk of unintended outcomes that your actions cause. You have taken decision, say to concentrate and to put just a few. At that time it may sound very attractive and intellectually very
appealing,
seductive to do so. But that is still not the same thing as our ability to bear the consequences of such an action, which may lead us to unintended consequences. When they occur, whether we have psychological strength and ability to deal with those consequences may or may not be.
True.
You may have intellectual understanding of these issues, but
on
you
an
may
Excel
not have
sheet you would have
psychological ability to deal with it. Therefore, if psychologically you can't, then don't do an action which is psychologically impossible for you to manage when the consequences occur.
Okay.
And therefore, if you remain within boundary of what psychologically you know that you can practice and live with, live within those boundaries. And do not try to exceed, because then invariably over a period of time, law of unintended consequences will prevail, and that time it may leave you naked, and therefore not only you will make layer 1 kind of error, it will lead you to layer 2 kind of errors which are emanating from your own weakened psychologically to deal with the adverse consequences of level 1 error. And that, I think, is more individual.
Okay.
Therefore, generally, too many probably is a sign of potential mediocrity of outcomes, subject to an exception where an individual can really emancipate, can really encompass more than usually you would assume, and will be able to deal with many businesses and reasonably well as individual who can't really easily deal with adverse consequences of very concentrated bet. For that individual, bit more than the usual will be making more sense. For an individual who intellectually may feel very confident about few, and capability wise also may still feel very confident to handle it, those few, if also that individual is to question whether psychologically he really has that wherewithal to deal with the possible adverse consequences. If not, then it may not be prudent. Therefore, you need to expand your boundary beyond just a few. I would say over a period of time, based on my own personal experience, based on my own failures and my own challenges that I've gone through, too little is really trying to play Russian roulette and trying to play God, where you are saying that you are holding the gun to your head and firing that Russian roulette bullet, and believing that chance is only 1 out of 6, therefore probability is high that nothing will happen.
Which is a theoretical probability.
It's a theoretical probability, because that even low chance of 1 out of 6, but if it does occur, the consequences are devastating. And therefore, usually wisdom will suggest that number of stocks that you should own should be more than merely what your intellect will dictate.
So can you put a number to that?
I won't put a
Minimum,
number to that, but
maximum?
I would say between 20 to 30, 35 names is something I would regard it as reasonable.
And will you completely rule out a long tail portfolio? Let's say, Bharat bhai, I follow this strategy.
Say 200 names? No, I would not do it.
Let's say I follow a strategy, and there was this coffee can thing. There was this example. So if I follow, let's say I believe in ASK philosophy, I believe in your stock picking ability, and you being a public figure, there are times when you have to sell a stock. So I buy whenever you buy, but I don't sell once having bought them, and I follow it over a 10-year period. Is there a likelihood, because you being a public figure and you being in, there are certain regulations, if a stock is flying too high, there is a time when you have to, cut down the position in that particular stock, which as an individual investor, I don't have a restriction. So if I buy whenever you buy, knowing that you've done your due diligence, your company has done the due diligence, and I don't sell, Is it a possibility theoretically that over a 5-10 year period I beat your portfolio?
Well, possible, but selling is not merely, unless it is an idiosyncratic decision to sell, without regard to the fundamental merits of that business, and for other idiosyncratic reasons you have sold, even though there are merits to hold, then obviously what you are saying makes sense and will work better.
Yes.
Because you may have institutional imperative which may reduce the amount of remit that you may enjoy out
like
of
in
your
mutual
decisions.
fund there's a 10% restriction. There would be a similar restriction in PMS. Even though you like the holding, okay, you are forced to bring it down. One, because your risk guy is telling you to do that. Second, because it has hit that 10% limit.
Well, reduction of the weight is, I think, when you say that it is hitting a limit and reducing it to bring within acceptable limit, those are more garden maintenance decisions, not fundamentally new plantation decisions. It's a maintenance decision.
Yes.
Pruning, trimming, etc. is more maintenance decision. I don't think it will have fundamentally very big impact between continuing to hold and trimming and bring it to a little more logical, acceptable kind of.
So can I rephrase the question, Bharat? But this is a very interesting. So let's say there's a small cap portfolio. So the portfolio has been given to the regulator that it is a small cap portfolio. So one buys a stock when it was a very, very small cap. And we know that the highest amount of wealth is created when a small cap not only becomes mid cap, but one of the rarest of rare when a small cap happens to become a large cap. So that is the highest amount theoretically of wealth creation that one can buy a stock and hold it for years, if not decades. Now, if you bought a stock, let's say when you bought the weightage was 5%, you're managing a small cap portfolio, it does well, so it hits a 10% limit, or it becomes a mid cap. And because of technical reasons, you are forced to sell it as a public manager. But we know that if it is really that 1 in a million stock, and if you hold on to it, and if you are in private,
that's where it comes down to. If it is that 1 in a million, where that 5% weight held without any contamination of external additional action may turn out to be over a period of time, say 500% of the value.
Which is likely
total portfolio.
with a multi-bagger.
Those kind of special situations, yes. Holding and sustaining without.
And that one hit can compensate. So here comes my question on a long tail portfolio, that I buy when you buy, when somebody of your caliber buys, because I know a certain due diligence has already happened and all the filtration process have been applied. But I don't sell when you sell. So in that process I might end up holding a few duds also in the portfolio, let's say 10, 50. But if I catch one such multi-bagger in that portfolio, and you never know, you always know in hindsight that it was a multi-bagger, that can, even one can compensate for all 15, 20 duds.
Is a possibility, but not easy to always conjecture.
Put it into practice.
Also, the selling, I'm drawing distinction between uprooting and trimming and beautifying. Trimming is to keep it prim and tight and within discipline limits. Uprooting is to sell it away. If selling away is not for an idiosyncratic reason, but for a merit, and yet one continues to hold something which you are selling because you believe the prospects are diminished, or if you are selling because something else may look more appealing, then it's a separate issue. Because then you are going to replicate even that new one and buy in.
But then that is also betting on a future that you were right one time. Okay, it's very rare. With your experience, you would vouch for the fact that it's very rare that you get winners.
No.
And if once you get winners, you should not be
too greedy,
too early,
easy to give.
So should I give one personal example? I happened to, and with due disclaimer, not a recommendation, 2 years back I happened to discover NVIDIA. So 2 years back I started investing in US equity market, happened to invest in it, and fortunately I was at the right place at the right time. That was my biggest US holding, and it became a multibagger. 5-6 months back, the valuation went to a level, and I am a Buffett student, to a level where I couldn't digest it, right? And it was historical PE valuation, so I happened to trim the position. From there it went further 30, 40, 50% today, and now I bought it again at a higher valuation. Now, nothing wrong fundamentally with the company, nothing wrong with the growth, and recently when it came out with its earnings, the earnings were equally outstanding. It shocked the market, the earnings shocked the market. So maybe I was wrong in hindsight, but temporarily, being a Buffett student, you can absorb a 30, 40, 50, 60, 70 P, but how can you absorb a 150, 200 P? Where did I go wrong in this?
No, this is just a chancy element. I don't think it is a very well considered, meritorious decision. One took a chance and it turned out to be dramatically favorable than you might have imagined. All logic might have suggested this is way too out and will blow out actually rather than sustain. But you took a chance and it worked in your favor.
So the earlier part was the easy part. Sorry.
You see, decision is not right because the outcome is right.
Right.
Decision is right when it was logical to make that decision.
Right.
Even if it doesn't turn out to be so right for many other considerations,
That
it's a
doesn't mean you are
separate
not
issue.
wrong. Yeah.
Equally, a decision which you make and logically correct to make, but turns out actually inferior one, doesn't mean that it was a bad decision to make. Therefore, consistently, if we make a decision which we think makes sense, rather than what may turn out to be a stray lottery, I think that, in my opinion, would be a more likely sustained approach. But one solitary lottery where you put 5 rupee note, but you made a 10 crore prize, may distort your opinion about how lotteries
So, Bharat bhai,
work,
my
or
question,
how
I am
chances
doubting my decision to sell, not to buy. So, when I bought it, I had done my analysis and I was ahead of the time. I was before the market recognized the potential of that company. That decision I am not doubting. It was a very well
No,
thought
I am
of.
talking only of the sell decision.
The
Sale decision is
because of
all-
valuation. I
if
sold.
Yes, so if all the signs are showing that, like Wipro in 2000, where it touches zenith of a most unreasonable type, and I realize
What was the
Grail,
P at the peak?
well, it probably was something like 200 times or something.
Okay.
And Infosys, similarly, both those stocks I rode for a huge time. Infosys 1 rupee put in turned out to be some 150 over a period of 2 years, 2.5 years. Wipro even higher. And therefore, it will give you a high and you are tempted to continue in an opium-inspired stupor, where you just...
So I knew that example. I came out of it, and here's the irony. Here is the Nvidia story is different from Wipro.
Yeah, but...
It did come out with a result on the ground which was way more than what the market was anticipating, in spite of market anticipating too high a result.
That is the same point I'm making. That whether decision is right, not simply because the outcome is right. Decision is right if it is made in sync with the known facts, likely probable future, which looks reasonable, and correlating that to the valuation if the decision sounded correct to do so, to part the company. The very fact that the outcome turned out to be surprisingly good result and therefore a great price thereafter is a cost that you will pay for making such decisions many times in your life.
So maybe human mind is not attuned to geometric progression, right?
Which is always the case. Which is why compounding
one did a arithmetical calculation and the company grew geometrically.
Yeah, but point is not whether it grew geometrically or not. Point is whether decision made at that point of time, whether earnings are likely to be arithmetic or geometric, if either of the facts is enough in doubt and you make a decision which is well considered, and then I would say it is a good decision, irrespective of what is the outcome which is happened.
It was a very rational thing to do. But one now feels that you cut off your winner too early.
Yeah, but that's a necessary cost that you pay when you make series of decisions, because you are not expecting to win the portfolio by a lottery. You are expecting to win the portfolio by a series of good decisions which have a higher probability of success than the probability of not such a good success or a failure. So long as you keep doing it that way, discipline, I would say that is the right thing to do.
Okay.
And therefore, even if you chuck out something which turns out to be dramatic winner thereafter, but if at the time of chucking out your analysis, logic is not idiosyncratic but correct. It is not out of the pressure of the market or many other extraneous consideration that you parted or greed or believe that now it is too much. That is where failure to imagine geometrical part will come by. That it has gone up 20 times, so now what? It can't be more. That is a very mechanical reaction which is understandable.
We should not look at how much you've gone up on your past portfolio.
Based
like
on
you've
what
been holding stocks like Titan or Asian Paints or Page Industries for long. Okay, so you should not compare your investment cost and your current market value. That is not a criteria. You should compare what the valuations are today and what is the future.
Whatever is the valuation today in the context of what is the future. Ultimately, Page, if it has worked in the past, doesn't mean automatically it has to work in the future.
Right.
There is no God's benediction.
Yes.
That something has to work for 10 years, has to work for another 10 years and another 10 years.
Yeah.
And therefore, every decision at every point of time is a continuous evaluation and continuous adaptation of the new reality, and keeping mind open that it may have worked so far, but there are infirmities and weaknesses which may be creeping in, and you have to be acknowledging of that and recognizant of that. Otherwise, you let lazy riding for long term as a decision making, which is not healthy.
And sometimes some winners keep on winning. That is also true. Some companies have that innate ability of...
Ultimately, what compounds? Compounding requires certain set of innate characteristics which work as a virtuoso cycle and keeps allowing it to win for a considerable period of time or produce outsized outcomes for a much longer period of time.
Yes.
But we must recognize our own ability to judge continued such success, and we must also remain alert to the possibility that external things change, context may change, and that may render an outcome which has been attained in the past may not any longer replicable. In other words, there is no merit for mechanical long-term holding. Ultimately, every time, even for a long-term winner, you have to constantly evaluate and constantly remain agile to possibility that you may be wrong or you may be foolishly wrong now to own it.
And one or two or three bad quarterly result is not what you are alluding to.
I am not talking of one or two bad results, or I am not even talking of necessarily price volatility. It is price volatility may be signal for you to examine more closely.
That's all.
That's whether all, something is right or wrong, at least be alert, because markets, when they throw a signal, then there is usually some reason, and it will be arrogance to ignore that signal and just believe that you are right. That will be foolishness or arrogance. But equally, our own ability to appreciate that ultimately nothing stays what it is forever. Everything is subject to law of atrophy. Something reduces, diminishes, and declines and dies at some stage.
Okay.
Long-term success deludes us into or lulls us into complacency, and complacency is the enemy of good investing. And therefore, even with the winners, long-term winners, we need to remain and retain that agile, counterpoint as to why we should continue to hold. Equally, what we do not own, we need to retain interested curiosity as to why we are not owning what is not there, what probably may be actually an opportunity. In other words, remaining counter to what is there is actually a good, healthy mind. If you have something, then you want to keep a mindset of finding reasons why you want to check it out. And if you don't have it, then you want to hunt for the reasons why you should not actually be owning it. Constant putting yourself in that quizzical mind is important. Ultimately, good investing is about ability to hold two contrary emotions on the same subject simultaneously in your head without making mincemeat of your mind. That you believe, but you doubt. You have confidence, yet you have concerns. You have trust, but you have skepticism.
Oh, so that is what our Shastras call Vivek Buddhi. So you have to be very alert, right? Yet not react too fast.
Because the things that lead to success of a position that you own, in that very success, the foundation for its likely failure are also laid.
Yeah.
And remaining alert to that is very important. But we all suffer from efflux of time. With the time, we develop less and less sensitivity to the adverse threats to that position or positions, and we start developing great regard for our own invincibility.
Yes.
Which is
and nobody is invincible.
Yes, and nobody is invincible.
So your decision to buy and your decision to sell, are these based on different parameters? So you will not buy a stock which has a very high valuation, of course, but you already own a stock. And because the market has recognized the stock and maybe it's gone a little bit overall, so that temporarily that stock is overvalued. Will you sell that stock or will you hold it?
Well, temporary overvaluation and not a significant overvaluation probably will put me in a mindset to hold.
Okay.
Because ultimately, if you bought a compounding business, a temporary overvaluation of a few percentage point is a matter of disregarding few months of returns or maybe a year of returns, which is not a great shake. If you are considering and if you believe that name is worth owning for 10-15 years and likely to create that outsized outcome. But materially higher price than what you regard as a reasonable value, such that it shocks your conscience, you must respond to that.
That's what happened
because
with me in
ultimately
Nvidia.
you are owning it only for economic reasons and not for any emotional reasons.
Don't fall in love with the stock.
Yeah. There is no emotional love to any of the names. Economics is the only reason why you are owning it, and if you think it is outlived or considerably diminished economics, then there is a reason to act. There is no need to be emotional about it. But we all are prey to that.
Yes.
And guarding against our own emotionality and weaknesses is what
one of the
makes us
characteristics.
hopefully improved investors.
Bharat bhai, so if you manage a portfolio, you need a portfolio tool. If you have to create a portfolio ground up, if you have an IT team, so one of my thing was never have a column of market price, but have a column of market cap, right? So that we can put the company in a context, how big or small the company is, vis-a-vis its turnover, vis-a-vis its profitability. Second, would you agree that you should not have a column for what is your investment? So is it a sunk cost? Having bought, let's say I bought a stock worth 10 lakh rupees. Having bought it today, does it matter?
What cost you own it is
a sunk cost.
A matter of merely accounting.
So then that column of profit also goes away. What profit I made today, if I had to decide
what matters is only logical reason to own or not own today, What you did in the past, what it prevailed in the past has only historical perspective and important, but nothing beyond that. The only reason why, and holding also is a decision, as much as buying or selling is
Holding is an equally. If you don't act, that is also an action.
Yeah, not acting, not deciding
Is
to act
also a
is an
decision.
action. And therefore, in investing, passivity of a decision is active decision. It is not a passive decision.
You constantly decided to not to act. So
only logical context is what you think is the value and what you think is, and what you know is the price.
So if you have to design ground up a portfolio tool which helps you track your portfolio. Okay, let's say you have 40 stocks in one of your strategies. What columns will include in that?
We have our own internal mechanism whereby we can on a live basis arrive at a price value gap for any name.
Okay.
Because we have a method through which we constantly have a value computation done. It doesn't change every day. Only when some input change that the value changes. But when the input change, value changes, and automatically the price value gap or the margin of safety is recomputed. And on a live basis across our portfolio positions we can compute.
Okay. How does a stock enter your portfolio, a new stock? What parameters you check before a stock enters into your... What is your investment universe, Bharat bhai?
Total number of names that we
keep a watch on.
About 250 odd names that we look at.
Okay.
What we own is probably 30%, not even 30%, less than that. 27% of that universe is what we own across our different strategies.
Yes.
Because not all strategies are alike in terms of number of names. There is a distinction, and therefore across strategies put together we will be owning about 65 odd names.
So you have an investment universe of 250 stocks out of 5-7 odd thousand stocks listed in the market, and out of that 250 your all strategies put together you hold 60-70 stocks.
So, yeah.
Which are monitored on a continuous basis. Okay, so how does a stock enter the universe or enter your portfolio? What parameters you
Those
look at?
are very simple. I mean, ultimately, the first and foremost is the character of management. I think qualitative filters are more efficient filters than the quantitative ones.
It's easier.
Is more important.
More
not
important,
easier.
not easier.
It is more important. Quantitative filters delude our mind and leads us to more mechanical thought process or outcomes or decision making. But it is qualitative judgments which are far superior filters. Quality of management amongst the qualitative features is the first and foremost. Ultimately, very few managements have sagacity, character, capability, competence, vision, foresight, execution, capital allocation, capital distribution, capability, resilience, fire in the belly, adaptability to do the right things time after time after time. And getting such managements is like a rare possession.
Yeah, so Bharat bhai, we are asking for a very rare individual here.
Yes, very,
right?
very rare.
I mean, the person has to be very,
And
very
you can't get-
motivated, very, maybe a bit spiritually inclined. I mean, these are very rare qualities in a human.
absolutely.
So that means those kind of management are very rare to find.
Very rare to find, and therefore you can't find a perfect one because you are also not perfect, markets are not perfect. So you try to arrive at least a healthy enough combination of these. But clearly you have no need or regard to own knowingly inferior and knowingly compromise. Then you are letting your arrogance override good judgment and good awareness of the facts.
So no compromise on quality of management.
Absolutely.
And is there a quantitative factor which can help us judge that? Like people say ROC is a proxy.
ROC is a proxy for a good business, but ROE in a way is a good proxy for the quality of the management.
Okay.
Holy Grail of
Both are quantitative factors, return on equity and return on capital employed.
Capital employed depicts more about the character of business.
Okay, and how does ROE depict the character of a management?
From return on capital employed, below that, you have financial structure decision.
Yeah.
How much debt and how much equity.
Yeah.
And then also tax part comes about as to how you embarked on your activities to arrive at most efficient tax. All these are reflecting on top of what is qualitatively description of a great business. ROC has nothing to show about quality of management at all.
Okay.
It is entirely about quality of business. Superimpose on that great business is what you do with that business in terms of structuring, financial structuring and engineering decision, your overall level of asset intensity and otherwise that you got in that business, and therefore consequent likely tax rate, because ultimately tax is a real outflow.
Yes.
And therefore if you can reduce your tax liability in a legitimate way, then you have improved the equity of the firm. And therefore holy grail of a great management, I think, is ROE. And a holy grail of a great business is ROC. But with a pinch of salt. I mean, these are quantitative descriptions,
which can be managed also.
Not managed, but it may not be complete description. Therefore, qualitative scrutiny of both those numbers is very important, because in investing, more often than not, what is not obvious is likely to be more valuable. What is not tangible is probably more valuable than what is tangible. Because human nature finds greater attraction to tangibility. Intangibility sounds amorphous and unpredictable or vague, and therefore less attractive. Human tendency also is to regard what is obvious is palpably satisfying, because it satisfies our inner urge to protect us from what is uncertain, because uncertainty creates that anxiety. Equally, human mind is designed, that's how Homo sapiens have survived all along, to try to deal with a threat or a perceived risk by immediate action. More often than not in investing, in good business or a good name, and what may appear as threats are temporary, and they may really be challenges and not threats, and we misconstrue them as threats, and therefore we may take immediate kind of action. It may be fatal to the long-term interest of owning that business. Something on the line of what you were earlier saying, that if you sell, somebody sells while you continue to own. Therefore, if it is selling is done for idiosyncratic reasons, clearly not listening to that is valuable. But if it is based on meritorious reason, then I think we need to examine that whether there is a merit in just lazily remaining with something simply because it has worked in the past. So I would say palpably what may be apparent, obvious and tangible may look more valuable, but great value in investing typically is in intangibility and less obvious and less apparent things. And listening to that voice and hunting for that voice or opinion is painstaking and not very comfortable, because it produces dissonance in the mind.
Okay.
The kind of dissonance I referred to earlier, that you have faith, yet you have doubt. You have trust, but you have skepticism. You have belief, but you have diffidence. You have confidence, but you have diffidence about it. And I think that duality, it works well. Ultimately, investing is many such dualities. Price and value is one such. Risk and return is another one. Tangible and intangible is another duality. This is one more such reality. The yin and yang of investing demands living with these incongruous sounding dualities.
So investing sounds to be very near to a spiritual activity.
In some very important aspects, spirituality has a deep impact on what you do. Serene mind is required
Yes.
to deal with investing. Otherwise, markets can
Play havoc with your
havoc of a pain out of your mind, and therefore, while you see things around, and yet you maintain your calm, even if the things look hostile or challenging and difficult, how you keep your mind calm and steer your way through is very important, and that is something that is exactly what meditation and spirituality teaches you, to keep your mind focused on the end game and to play it by rules and principles rather than by reactivity and by episodicity of the situation. Equally, spirituality also, in a way, you say you are a player as an investor, but you require a mind of a referee, of a judge.
Okay.
Therefore, you need a mind of a bystander who observes game, but is not actually playing. But as a player, you are also playing the game.
You're playing the game and you're also...
Yet you require to have a bystander mind, and that is very, very tough to do.
Yeah.
That bystander behavior, yet being actively involved in the game, is that another duality.
Okay.
And therefore, you're right. I mean, investing has many deep roots in many branches of knowledge. Why only spirituality? History has a lot to teach. Psychology has a lot to teach. Even physics and sciences have a lot to teach. It's not economics and finance alone which, I would say even literature teaches you.
So it's a complete holistic activity.
It is a lattice work of many branches of knowledge.
Right. Bharat bhai, you have many investment schemes, right? So one is your India Entrepreneur Portfolio, which is probably the biggest PMS scheme in the country and a very old scheme. And you have a new scheme strategy that you have come out with known as Lighthouse. Do you want to throw some light on these two?
Well, Indian Entrepreneurial Portfolio basically, as the name says, buys only into entrepreneurs. And again, the entrepreneurs whom you believe, who have fire in the belly, who have skin in the game, who have resilience, ability to fight with the challenges, sagacity, as well as competence and integrity, and good capital allocation and good capital distribution record. But the other parameters of our investing framework remain the same. We want to buy a great business. It must also grow. Therefore, it must have a meaningfully large size of opportunity. If it doesn't have a great size of opportunity, then it may remain a maverick, kind of a niche, but may not really grow to be meaningful. And ultimately, growth is elixir of equity investing. Without growth, businesses don't create value.
Growth is elixir of equity investing. If there's no growth, then as you wrote in your book, and I'd like to say this is one of the best books on investing I've read, Bharat bhai. And it is not available in public parlance. And I would call Bharat bhai the Warren Buffett of India.
No.
And maybe some things I have not learned there. Those questions are answered here, Bharat bhai. We are waiting for a second book from you. Let me announce it on my AUM Finance podcast so that there's a pressure on you to come out with the second book.
It is in the works. It's near. It is almost near completion, but that last leg is taking time.
So this podcast might be out in the next 3 months. So I hope your book comes out before the podcast goes out.
Unlikely, but it is.
No, this is one of the best investing books I've read, and you keep rereading and rereading and rereading and revisiting them. Now, one of the things you alluded in the book is, one I gathered from you, you're market cap agnostic. So many people ask large cap, mid cap, small cap, and what I've heard from you, I've been following you, that you're market cap agnostic. Yet there is an example in your book where you compare the size of the fish and the size of the pond. Okay, so there are three various possibilities. A big fish in a big pond, which you say is a complete no-brainer, that is where you should be investing. Then a big fish in a small pond, complete no, because the size of the opportunity, the TAM, addressable market, is small. Okay, and then the last one you select is a small fish in a big pond. Okay, now here is my question. So when you say a small fish in a big pond, you are analogically saying it is a small cap. So you are saying invest in a large and a small cap.
No, the pond refers to size of opportunity. Size of opportunity has to be large. Size of the fish or the player or the company is not of a great consequence. If the pond is large and
vis-a-vis in relation to the size of the fish, that means market opportunity in relation to the size of the company.
Yes, now size of opportunity has to be large. If the fish is small but capable one and has fire in the belly, using a large size of opportunity, it will grow to be bigger and fatter fish over a period of time.
Isn't there a possibility of the smaller fish being a small fish getting eaten over by a big one?
So that again is a function of the capability of the fish, which is what I talked about. Therefore, what you need is large size of opportunity plus a capability of the fish to use that opportunity. The capability is there, but the size of the fish is small, is not a threat or is not a concern. But if the size of opportunity is large, but the fish doesn't have capability, then it is still going to remain stymied and small and insignificant, and therefore it is not of use. You need large pond and a capable fish, both.
Who wants to grow bigger over time?
Who automatically then will grow bigger. Because the opportunity is large, fish has capability and fire in the belly and desire to do
grow
big. Automatically it will grow to be bigger.
Okay.
Whether start condition it is small or mid-size or a big one is not critical. Investing is about future. Past is merely a context and a reference to study. But key decision lies in the future. Therefore, if you believe that the fish the size of opportunity is large and you have come to judgment that the fish has all the traits
of becoming further
big because it is capable management and hungry management to achieve right and honest kind of growth, then it will lead to those outcomes.
Okay.
And therefore, large fish, if it is there in a large pond, that's welcome. Large pond, small fish but a capable fish, that is equally welcome. In fact, may do even better. Small fish in a small pond, in any case, is a disaster. Large fish in a small pond actually may mislead you.
Okay.
And may lead you to slow decline and strangulation.
Right.
I think finance is a very important subject in everybody's life, whether you happen to be an atomic physicist or an astronomer or a doctor or a poet or a businessman. I think finance is a very, very important subject. It cannot be left to chance. It cannot be left to idiosyncratic forces. Therefore, any effort made by anybody to provide some pathway towards finance and learning core, essential, first level principles is a very valuable idea. And in my opinion is a public service, because unfortunately our academia doesn't teach
you. I believe Bharat Bhai keep giving lectures all over, and I believe financial literacy is not even present amongst finance graduates or postgraduate.
Yes.
It is really missing out there.
It is. So that is very unfortunate.
Yeah.
I think like you learn languages, like you learn history and sciences, even though you may or may not grow to do your professional life into, some amount of exposure to basic ideas of finance over a period of time, basic conceptual exposition and exposure is a very vital thing. You may not want to be an expert in that area, or you may not want to take it up as a career, but awareness of fundamental principles will have great societal outcomes over a period of time. Therefore, teaching or leading part to conceptual good understanding of finance is a very valuable service to the society. I strongly believe.
Yes.
And much as I very strongly believe that good investing is a trusteeship responsibility for your clients. They trust your money. Trusting money to somebody else is not
an easy thing. Yeah.
Even a spouse doesn't easily give a check to the other spouse.
Yes.
Therefore, trusting somebody with money is an article of faith, and that responsibility is a trusteeship responsibility to be discharged with a great panache, with a great intensity.
Yes.
And equally, teaching or educating or exposing about at least fundamentally basic principles, first level principles of finance are vital. And I think in some sense that is what
that is what is the idea of this podcast. So I blog, I teach, I do financial literacy coaching, I practice it, and I am podcasting. So people say you are doing too many things, and I say I'm doing only one thing.
Yes.
My area of expertise is personal finance, what to do with your surplus money. That is one area where I've concentrated all my knowledge and experience into.
Correct.
So, and yes, it gives you, beyond the fact that it is a money earning activity for you, it gives you a lot of satisfaction that you're at least taking care of the financial worries of the people whose money you are managing. So it's a very satisfying profession that way.
So rather than counter, I'm saying pro to, I think, what your firm seems to be doing and wants to be perpetuating.
Any question you would like to ask?
No, not really.
I know in the world of investing, I can't give you any.
No. But that is incorrect to assume. We all learn from each other. Everybody learns from everybody. And everybody has something to teach, so long as we are willing to keep a mind open. And I think one thing investing teaches to keep a mindset of a student forever.
Yes.
At least I, for one, remain a humble student of investing all my life. Whether when I first began with the baby steps 35 years back or today, my hunger and my belief about investing and learning have remained the same.
So what's the last big lesson you learned over the last 1.5 years that you had not known before?
Well, I think COVID was a staggering kind of a sudden...
Did you get scared?
No,
You're managing public money with the kind of size of portfolio you're managing. Did it...
Not getting worried will be a very wrong thing to say. Obviously you are worried.
Yeah.
Obviously you are deeply concerned. But whether I felt threatened and insecure, no. And all along during that period, there were many recorded dialogues of mine where I said, well, by all accounts, this is a tumultuous kind of an event with epoch-making kind of consequences apparently that you may witness in your own lifetime. But still, a good question to ask is, this may sound overpowering, but whether it is permanent. And my opinion is it is unlikely to be permanent. It may look threatening, it may look very overpowering, but I doubt whether this is permanent. Human history is filled with a lot of such events, and humanity has recovered out of every such event. So I have no reason to believe that however powerful it may sound, still it is just one of those events and that eventually will pass. And we will live to tell the tale.
Hence, hold on and don't sell in panic.
Hence, if Challenge is humongous but temporary. The biggest mistake to make is not to use that challenge by buying something which is become unduly cheap compared to what, if such a thing were to be permanent, it would imply. Price is implied as if the threat is permanent.
Yes.
While values will be derived from impermanence of that challenge. If that hypothesis is correct, the challenge is impermanent even though it is large, then the value is much higher than the collapse prices, and therefore using that threat as an opportunity is vital. The second level of error one can make is to throw away what you have.
Bharat, one last question. So equity is an optimist guy's investment. We are, because we are bullish on the future prospects of the companies we are buying in our portfolio, that's why we buy. Now we've agreed both that there are these black swan events like COVID or geopolitical risk, a world war is always around the corner, a terrorist attack is always around the corner, right? Somebody like me, I am 120% in equity. So, and you're managing public money. Not only your portfolio would be, a large portion of your portfolio would be in equity, but you're managing this size of portfolio, biggest PMS portfolio in the country. Doesn't these things worry you? Anything, one day morning we wake up and a black swan event can happen.
No, I mean, you can worry only about things, A, that you know, and that you can design method to fight against that risk. If you don't know something, then there is no point in worrying about what you don't know. If you know something, but there is no way to fight against it, also worrying will not help. Therefore, worrying will help really in no situation. Either we know something and therefore we can design an inoculation device against it, then it is an issue. Therefore, what cannot be known or what is not knowable, what is the point in getting overcome?
So this is like an unknown.
Yeah.
So but things do happen which have not happened before.
But
so
why
do we prepare? No, so let's not worry. But can we not prepare for it? Can we do some asset allocation for the rainy day?
Well, asset allocation in a wider context is a good idea. It is the way asset allocation is applied in a kind of very formulaic way, which I regard as not very efficient. Ultimately, putting some amount of money to your consumption needs, which can protect those consumption needs, is vital. I mean, real estate is one such consumption, a house to stay or an office to operate from or a factory to produce your things from or a shop where you conduct your business. It is an asset that you are consuming on an ongoing basis, and therefore it is important to own it. And without hopefully any encumbered liabilities attached. Equally, protecting your routine, known and some amount of contingency consumption and protecting, securing it by some kind of an asset which will have less price volatility, even if it is yielding less, say something in a fixed income type. Again, I think it gives a peace of mind to a lot of people, and therefore that is important. Not everything is important simply because it gives you highest return. Ultimately, investing is for the peace of mind, to give you a sense of security, to have your destiny under your control.
So if a certain percentage of my portfolio in fixed income gives me peace of mind, nothing wrong with that.
It is important objective to achieve, because without that peace of mind, what is the point in having wealth? Having wealth without peace of mind, where you are a nervous wreck every day, is the worst kind of thing to do. Therefore, in some meaningful way, you protect that ongoing need plus some contingency is a good idea. With some conservative assumption, you can allocate some corpus to such a thing. Gold is another some such consumption need, which you may not as an investment, but probably as a consumption. You can
And gold outside jewelry as an investment?
Gold outside jewelry as an investment, to my mind, is not a particularly great idea. But if one has to, then I think gold bonds are the most effective way to buy gold.
Because people say it's a pessimist guy's investment when things go wrong.
Yeah, so in a way,
inflation beating, countering.
So in a way, if you have a jewelry, that also is gold. You can use it, as well as it realizes and preserves its value over a period of time. Is a store of value function. But if you're purely investing, maybe sovereign gold bond is a better idea rather than owning gold, if purpose is only investment in that. Beyond that, I think money has to be in wealth creating asset, which is equity.
Great. Thank you very much, Bharat Bhai.
No,
you have been very, very generous with your time.
Thank you.
And it was a pleasure talking to you.